everybody. Welcome. Good afternoon. Welcome to Fundamentals for Startups, put on by CoMotion Labs. My name is Anson Fatland. I am an Associate Vice Provost. I am the Associate Vice Provost for Innovation Strategy and Ventures here at CoMotion, and we are thrilled that you were able to join us today. It's gone. Maybe it's on the screen. I am not Siri Vimolchalau. Siri runs our hardware incubator, and she is so dedicated to her members that she is actually helping bring some material in off of the loading dock and up into the space, so she was not able to make it here today, so I have been asked to stand in for her. If you have joined us before, you know that CoMotion Labs is a multi-industry incubator that hosts early-stage startups that come from both inside and outside the university community. We are committed to nurturing and enabling the success of our startups, contributing critical infrastructure and opportunities for learning, mentoring, and networking. Hi, Deb. We do this is very important, we do this without taking any equity or IP, whether you're from within the university or not. CoMotion Labs, our incubators, do not take any equity or IP. We have 3 incubators in 2 locations. In Fluke Hall, we have our hardware incubator and our life science incubator. And here in Condon Hall, we have our technology incubator, which is where we are today. If you are a founder looking for not only a community, but also a place to start and grow your company, we would love to talk with you. Fundamentals for Startups is a regular lecture series and is open to anyone and everyone who is interested in learning about entrepreneurship and building a startup. Every week, we bring in experts with diverse perspectives and experiences to share insights, inspire action, and offer space for questions. And this week is certainly no exception. A few announcements before we get started. All of our Fundamentals for Startups presentations are archived on our YouTube channel and on the CoMotion website, where you can filter by topic. And to learn about and register for future Fundamentals programs, you can visit CoMotion Labs online, and you can subscribe to our YouTube channel. Now with that, today I am excited to introduce Yoko Okano, who is a co-founder at First Row Partners, a pre-seed investment firm that focuses on emerging tech companies, processes, and markets in a world transformed by AI, to say the least. Yoko also teaches classes on venture planning and execution for the Burke Center for Entrepreneurship. And today, she will introduce the basics of fundraising from a founder's perspective and talk about working with angel investors and VCs. And one of the things that I thought that was particularly interesting is I was able to read a little bit about Yoko's background and First Row's approach to diligence and how they actually go about their work. So from an undergraduate degree in music history through work at Google, research firms, startup firms, other incubators, I think Yoko's got an amazing background and a very unique approach to evaluating with and working with and helping entrepreneurs be successful. So I'm very excited to hear what she has to say for us today. So please join me in welcoming Yoko.
Awesome. Thank you so much. All righty. Thanks so much for joining us today on a Friday. So intention here is to be a little bit of an overview. The folks from MS Entra, or if you've been in a workshop with First Row before, some of the slides will look familiar, and that's great. I think it's, one of the things that I learned from my time, I did professional drumming for a while with Japanese drums, and one of the things that I learned from that experience is to have a beginner's mind. You can see the same fundamentals over and over and over, and if you approach it with curiosity, there's always something new to be unlocked. And so, if you've seen stuff like this before, great. Let's dig in a little bit deeper. If you have not, great, fresh information, let's go forward. Slides are up. Great. So a little bit about us at First Row. We are a pre-seed specialist firm. And what does that mean? We really like to look at companies in their earliest stages, often as they're raising their first round of capital that's just beyond their maybe a friends and family round. We invest in opportunities where AI and technology is empowering people and the builders and the makers in our world. We do skew software. And so folks who are working on hardware, life sciences, again, you'll have to make some adjustments to what I'm saying. but just know that where the skew is coming from. And we'll get into this more, but for me, I define pre-seed as anything under 10 million in valuation cap. If that terminology is new to you, then we'll talk about that at the end as well. A little bit about myself and my partner, why we work as a firm. As Ensign kind of mentioned, we are both actually deep appreciators of the arts, and I think that actually drives a lot of our investment process. Hear it echoed throughout, hopefully. The other piece I think that we share is that we started on the front lines of technology adoption. My first job at Google was answering the phones for the 1866 number for Google AdWords. So there was only one like public number that was available for Google AdWords at that time. It's for Google at the time, and it's for AdWords. And so we'd get calls from, hey, I don't want my face or house listed on Google Maps, to, hey, I really need to dig deep on why this my AdWords optimization is not working. And so you had to really kind of cover a lot of ground. But what I heard was that real frustration that people had in adopting this technology, right? And I think as founders, it's so easy to forget that. You think that if you build it, they will come. They will not, as you know. And so onboarding is something that I key onto a lot. So before I go through all my slides, I would love to hear a little bit about what you know or what you've heard about fundraising. Just what do you know? What have you heard? Yes?
You have to try a lot of different firms and a lot of different investors before you get a yes.
Correct. Yeah, you do. It's true. You have to have a lot of conversations before you get to yes. What else? Maybe here.
That it's ongoing, so you can never have enough money, so to speak. So it's even after you raise, don't stop there. Continue to have those conversations and continue thinking about raising.
That's true. As a CEO, you're always fundraising, whether you have a round open or not, right? You're always in conversations with folks, who could join now or who could join at later rounds. It's a good point. Let's take one more. Yeah.
Get your legal stuff done first.
Get your legal stuff done first. And we'll talk a little bit about the diligence piece as well. But I do think that, especially as you depart from the, say, friends and family or closer people you do want to have a lot of your ducks in a row before you move forward. And what are the biggest questions you have? What are the things that you're like, what are you Googling for late at night as you're thinking about your fundraising? Yeah.
What do the funders want?
What do the funders want? You're not a plant, and yet I have that slide in here, so perfect. What do the funders want? And this is also for me to also understand, what are the questions you might have that we're not going to cover, right? So I also want to make sure that, I'm cognizant of where we're not going to be able to have coverage. So this is not intended to have you map directly to my slides.
How to find the right investors for me and my company, and who shares our company's mission and vision.
I love that. Yep. I think, to map to the earlier thing, you have to have so many conversations, and part of it, I think as a founder, often feels like you are just trying to get to a yes, but the reality is it should be a two-way filtering process. You're going to have a lot of conversations that hopefully you'll walk away and go, that is not the right person for me. And that's okay. That's good. Let's take one more. What questions?
If we're setting our own price for a smaller round, how do we set that price and figure out a good valuation?
Valuation. Is there a science behind it? Quick answer, no. We'll talk about it. All right. So topics we'll cover. We'll talk a little bit about why. Why am I raising outside capital? Who is going to participate in those earliest rounds? What are they looking for? And then where do I go from here? So, all right, why should I raise outside capital? Before we get into the nuts and bolts of it, I think it's really important to always start with why, right? There's a lot of entrepreneurship that is there. Quick note, because I'm running out of cash is not a good answer, right? So sometimes I'll talk to founders and say, oh, well, what made you decide to start this round? And they're like, well, because I really only have like 2 months of runway left. Okay, great. You have not told me anything about what this capital will do beyond extending your runway. So some of the things that might sort of fit that, like, why am I doing this? There's some sort of time-sensitive need. I feel like this is a little less often the case, but it's like, oh, we're first to market and we need to do this, is sometimes what I'll hear. More, I think, attractive to me is when you say, we know we are ready for more fuel and we know where we would apply it to make it go, right? But fundamentally, I think more importantly than that, for you as founders, you should really be thinking about, as you're entering this phase, do you want to actually get on this venture treadmill? Is your intention, of course, to build and grow your company, but are you also interested in delivering a cash return for your investors? Because that is what they are looking for, right? So I think it's always important. I always like to kind of frame it in both ways. I think founders are like, of course, we're all going to be successful, great. But as investors, I have slightly different incentives that are pushing me, right, at a certain point. So what do I mean by the venture treadmill? You've probably seen this. It's from Wikipedia, so it's very easy to find. But it's about the startup fundraising cycle. And so I would say there's a few things to point out. One is that there is an unknown amount of time here, and it's a pretty long time horizon. You're at the very, very, very beginning, right? And the other thing, too, is that there are multiple stages listed. So you're likely, the venture treadmill is literally this thing of hopping from lily pad to lily pad, this round to that round. You don't want to raise too little to fall short. You also don't want to raise too much and flop out on the other side, right? And so that's really, I think, when you're venture scale and if you're on that venture treadmill, that is effectively what you're doing until you get to the point of returning capital, whether it's through M&A or through some other exit. This slide will be stale probably as soon as we talk about it, so don't take too much credence to it. But I will say, it's really helpful to understand kind of these definition of various stages. Right? Typically, in our pre-seed rounds that we're participating in, we're seeing folks raising between $500K and $1.5 million, right? Again, we like things below 10 million post. That was not true, end of last year. So these things fluctuate over time. But I think for us, and I would say that the numbers of how much you're raising, the valuation cap, those things will fluctuate. But who is participating roughly stays the same, and then sort of the signals will also roughly stay the same, although again they fluctuate a little bit. So typically we're kind of seeing MVP, there's some signals happening. As you get further along, and I would say this is going back to that start financing cycle thing, you're going from all risk to value creation. And as you go along, also becomes much more of a spreadsheet story than a signal story, right? Often at the very, very beginning, these stages that if you've never raised capital you're really looking at what's called faith capital, right? People trust in you. They believe in you and your ability to execute. That's why you'll hear a lot of angels say, what do you look at? Team, team, team. The way people describe that team might be a little different, but it really is how much belief do I have in you to be able to execute on the plan you're setting forth. Risk capital, as you start to have a product in market, we're starting to get some signals, interesting. The key go-to-market levers, is this working? That's what becomes much more interesting to me. And then I sort of, as a super early stage investor, I sort of think of growth capital as like the spreadsheets folks. They really, I had a Series B investor colleague tell me that his job was much more not about picking the winners, but really about making sure the winners wanted them on their team, right? That's a very different story than at the pre-seed stage. I also want to take a moment to also talk about the capital match with your opportunity. This kind of goes a little bit to that filtering question too. So if you think about various types of businesses here on the left, there's some considerations to make. and then the various capital sources that might be available to you. We're not really talking too much about, like at the earliest stages, the last three options here around like loans and venture debt, these aren't available to you at those earliest stages, right? You have to have a certain amount of revenue often or proof points to get access to those. And again, I have the most context on angel and venture capital, so you'll hear a skew there. But to walk through an example, let's say you're a brand or a CPG, you have a new canned soup you're bringing to market. Let's start with the green market size. Consideration, like who doesn't like soup? You know, most people like soup, so that's pretty good market size. Customer diversity, a lot of people like soup, so lots of, options there. Distribution, again, since a lot of people like soup, there's a lot of channels to get there. But if you start going into the yellow, it's like, is this scalable? What do I need to get that first can of soup out the door? Do people want soup all year round? Recurring? Is this recurring, or is there a seasonality to it? And then I think with a lot of brands in CPG, what we're seeing is the exit potential as an investor is not as lucrative, right? So that's a little bit of a yellow. And then the red is, of course, the capital. I need to make soup to sell soup, right? So there's a certain amount of investment needed, and not super patentable. And then the conditions to scale, again, like you can build some economies of scale with soup to a certain degree, but it's not the same as, say, software, which we'll talk about. So with those considerations, the capital sources available to you, looks like customer revenue. It looks like maybe putting in my own savings to start the soup company. It might look like personal guaranteed loans. It might be angel, like maybe I have a friend of a friend who happens to really love soup and wants to help me get this off the ground. Venture capital has been a little bit waning in interest these days, but it's still available. Grants are probably not as applicable. Custom design partners are not, right? So I think that's sort of how it maps. Now, when you look at enterprise SaaS, why so many VC firms in Seattle love this, lots more in green, right? Capital required to first revenue, market size, not as much on patent protection, right, for most software, but there's a lot of green here in the considerations, right? And so that's why it maps to a different set of capital sources. So I would sort of think through, for your particular business, think through the considerations and how, what's green, what's yellow, what's red, and like how might that map? Are there grants that make sense for me? Are there design partners I can really work with? So that's a little bit of the why this funding source. And another reason why we like to go through this is often you hear a lot about angel and venture capital, but there's a lot of other ways to get started, right, that don't require bringing somebody else onto your cap table. So I think that's always something I want to mention because it feels like the only path, and it is not. So when we're talking about angel or venture capital, who is going to fund this venture? So do most folks here know what an accredited investor is? Yes. Anyone unsure want to talk about it more? We could talk about it more. We can always talk about it. I think it's really important to understand that an angel investor, there's specific guidelines that are set forth at the SEC around who can invest. And this is literally, it's interesting. I always like to have a little history side note where these requirements were put in place to prevent people from selling literal like snake oil, right? Because people were getting kind of conned out of their savings. And so they wanted to make sure that there were folks who could make credible, educated decisions on taking this risk, right? Because this is a risky asset class. And so those people are accredited if they fit any of these criteria. Now, this is not talking about equity crowdfunding. I know less about this. And so just know that we're not covering that aspect, but if you're doing traditional fundraising from a venture perspective, this is typically what fits the accredited threshold. And so when you look at those, you might realize that if you have a friend or another, a friend couple who all work in tech, their salaries may make them accredited. So that's just something to consider. Now, if you do have friends who are considering angel investing, make sure they talk to us, because I would say for individual angels, it is a very high-risk asset class. So the flip side of this workshop we do is often for early-stage investors. And if you're making one bet on a super high-risk asset class, that's very dangerous. And so we want to help folks make sure they're building a portfolio around that. So that's another sort of asterisk to keep in mind. And we always love to include this as well, because often when you're out there at a networking event, you were just at, let's say, Techstars, and you run into an angel investor named Joe and a VC named Yoko. We're both individuals, right? And we both invest. But you're talking to Joe, and you realize that actually Joe can make his personal decision because he's an angel. Me, I have a whole background of boxes behind me, right? So let's talk about sort of the boxes and what they are. So venture capital firm is, first row is the box in red. Minda and I have created this entity. And then for every fund that we have, we might create a general partner, right? This kind of does a lot of the management of the fund. So in the blue box, right? And we collect our own investors in the white box, our limited partners, and they put in money into the blue box. And we make our individual investments based on a specific investment criteria. So we draw a box around ourselves and we say, we will make these types of investments at this stage, with this check size, with this type of thing, and we sort of draw that box around ourselves. And then as the investments have exits or have some sort of return, it flows all the way back through up top. So the reason why I think it's important to understand this is a few things as a founder, right? Yes, angels are driven mostly by personal interest and might be part-time. There's wide variation in frequency and check size. As VCs, I have basically, I may have a deployment period that I have promised to my LPs. I have to deploy this amount of money in this amount of time, which means if I said I'll give you 20 companies in 3 years and it's year 2.5 and I've made 5 investments, I might be in a really different scramble, right? And so there's a lot of these things that will be important for you to understand as a founder. Where are they in their deployment cycle? How roughly are their companies doing? You can often, VCs will list their portfolio. Are there a lot of ones that have cratered? What does that mean from a me returning to my investor's perspective? And what does that, what does that mean for my next fund and that fundraising story? And so it's good to kind of read through the signals a little bit. Let's see, yes. And each investor, again, brings their own expectations, right, around return time frame. If you're at the very beginning of my deployment period as an investor, great. We have a lot of time together for me to not be super ready for you to exit. But hey, we are creating 10-year entities, right? So maybe, I made an investment in year 4, and then you're kind of trudging along, but it's it's year 8, 9, and suddenly that acquisition doesn't look as bad to me. You want to keep going, but we're going to have a different perspective at that point, right? And so at the point of investment, often you're kind of aligned, but over time, the paths start to diverge a little. But I will say one of the great things, and on the flip side, it's not all bad, right? On the flip side, the investors, whether angels or VCs, can be really good stand-ins for advisors or some operational expertise that you're not yet ready for, right? This is where kind of people who you could never dream to hire as a CMO, but hey, they'll meet with you once a quarter to talk about your marketing strategy. Awesome, right? That's great because they're also invested in your success as investors. So who, why, what? So what are they looking for? I think it's really important here to kind of consider the environment. I think right now, especially, we're all going back to those fundamentals of survivability from lily pad to lily pad, building a really good, sound business. it's also important to call out that all this funding is subjective. There's no like checklist or like formula, right? Because unfortunately, well, I guess unfortunately, if there was a checklist, we would all be like just rich and this wouldn't be as much fun. But that's the way it is, right? So I think it's always, I think for investors, whenever I talk to a company, I'm always thinking about, is this my stage? Does this fit into that box I've created for myself, right? Do I see this going to a liquid exit of at least 10x in 6 to 8 years? Sometimes, right, like for, a fund might be going on a return, or some funds evaluate based on this idea of, could this return my whole fund, right? If I'm writing a 100K check, will this return my full fund? And that's the type of math that we're doing as we're making the investment. I think the one thing I love mentioning too is and I talked about this earlier, it's not about extending runway. It's really saying, are we getting the spring loaded up to leap to the next place, right? Is this team built to, can this team build and sell? Are there some market signals coming for demand, right? We're not just, again, if I invest here, it's not just about kind of continuing on the path, but it's more about knowing that we'll get somewhere farther, bigger. And this is, a good example is one of our portfolio companies. I said, hey, they were really excited. They were doing, a new customer every month. And then they were getting really stressed because they're like, oh, we didn't have a new customer last month. And I'm like, okay, that's okay. As long as whatever you were doing in the last month is going to help us get 5 new customers next month. Or maybe it'll be 2 and then it'll be 5. But it's really just thinking about, like, rather than that linear growth, what are the things you're doing? You could pause and say, hey, let's rejigger our onboarding flow so that we can actually do more self-onboarding. Now we can onboard 5 at a time versus 2, right? So I think that's really the type of activity I want to see versus this plan to do linear growth. And of course, as a pre-seed investor, you're on the venture treadmill. I want to know, are the things that they're shooting for going to help them with that next round? Because if not, then you're going to get to the next round and we're going to just have trouble, right? And that's going to be the point at which it kind of falls off. And then for us, it's really important to know, like, do I believe this is the team that could be wildly successful? And could this wild success be a huge success from a market standpoint? So as you know, Minda and I come from that arts background. This is why we love this slide. But it's really hard to pitch to investors as founders because it's like you're an abstract artist or maybe you're an art curator and you have walked me into your gallery with a blindfold on and you're trying to tell me about this piece of art. Think about what you would say to me to help me, let's say, replicate this picture on my own, right? That's really hard because who knows what I'm looking at? It is about watering cans, right? But it's like, again, like what are the words? If you told me, okay, just draw a watering can, I don't see the same vision as you, and I might not be excited. I'm like, a watering can, cool, right? But this is, so this is why it's really hard to pitch. And so it's helpful to think about the various parts of the painting. You can break it down using like various frameworks. So we'll talk about that. The other piece layered on that is if you have the context of, I'm an investor and I want to know how this machine is going to make me money, right? You're going to put money on one side, more money comes out the other. That's effectively what we're trying to do, right? And this money should at some point be self-propelling down the way. And angel investment is one type of fuel that goes in. But effectively, you need to show me the machine. And the parts of that machine, these are some of them, right? What's the market need? How big is that problem? Who is the team? Can you solve it? And the problem and solution, does this actually solve the problem? And your go-to-market, how will you get it there? So those are some of the parts of the machine. It's not exhaustive, but that's like a lot of what those early conversations are listening for. The other thing I'm listening for is, will these milestones unlock that next funding round? right? And how you understand what the right milestones are is talk to other founders. This is a great room, right? All these communities are great because you get to talk to somebody going, oh, you just raised a round. Tell me what was it like? Tell me what people were looking for. What are the signals they want? And this is actually really important because that's going to be way more helpful to you today than reading Crunchbase or reading AngelList and trying to figure out like what the last round like funding metrics were, right? And I think fundamentally what you're really trying to understand is what makes you extraordinary. What is so unique about you, your approach, and your differentiation in the market that will, when you get to that next lily pad, the next one you can see it, right? And the question about valuations, again, unfortunately, more market than spreadsheet. And that market is in talking to other folks, saying like, okay, you just raised an angel round. Did people, were people using convertible notes? Were they using safes? What were they using? Was it a priced round? Highly unlikely in this scenario, right? So you want to really kind of have a good sense of what the market is, what factors you have that might put you above or below, right? And so, Seattle as compared to the Bay Area, that might change, right? What if you were in Montana or, Missouri? What does that do to your evaluation expectations? And so I always like to say, like, come to the table prepared, not necessarily to say, like, this is the terms that I have, join in or not. But most of the time, if you're raising a round, people will say, okay, well, tell me about the round. Oh, well, I'm raising about 500K. And they'll say, okay, cool, do you have a lead? What I'm looking for is, what's the price, right? And do I have a lead? No, I don't have a lead, but I am expecting to be within this range. I think it'll be, in the 3 to 7 or 3 to 5 range, let's say, right? So come kind of prepared with an idea of how that dilution fits into your long-term strategy. And yes, you will hear no a ton. We say no far more often than yes. When you have those opportunities to learn from the no, you will not always get that opportunity. Some people will just say, we're going to pass. Sometimes people will be open to having that conversation. Sometimes they won't, right? Try to learn from those no's. And actually, that's often in looking back at your notes from the call and being like, these are the questions they asked. They said no, and the top 3 things they asked about during our call was competition, market landscape, and competition. Okay, maybe that's part of the reason that they didn't see my unique differentiator, right? And founders, I think sometimes it's hard because you're so excited about what you're building. And so when you're saying like, oh, well, like we're gonna launch next week, I'm like, cool, I'm gonna wait until next week to talk to you. Because I get more data. I'm always looking for more data. And so just know kind of the false potential like parameters you're putting in place. And so, and you're sort of saying like, well, I'm launching next week, so now is the time to get in because next week we're gonna launch, our metrics are gonna be awesome. And then the price is going up, right? Will be oversubscribed. That sounds exciting. Does that generate the FOMO you think it is? Probably not, because again, I'm like, ooh, I'm gonna wait and see how that launch goes. So just know that that balance, right? And when people do say, oh, you know what, you're too early, you need more traction. Don't be worried about ask that follow-up question. Okay, what types of metrics or milestones would you expect me to be at? Or what are the things that would make you really kind of lean in again, right? I think it's important to say, and sometimes they will move. It'll be frustrating because they'll say, well, I just need to see that you have customer revenue. You're like, cool, got it. And you come back to them a couple months later, I have customer revenue. And they're like, but we really want more customer revenue. Like, okay, so just know that they might move dependent on, again, the market cycle. But it is worth trying to kind of get a little bit more clarity there. And you'll also be able to tell for those folks who say you're too early, and when they answer that, it's pretty wishy-washy. That's probably just a no, but they're being nice, right? But for some people who say, yes, you're too early, I would actually like to see you have like 2 design partners. Okay, cool, like, can I keep you updated on our like monthly updates? Yeah, absolutely, right? And then as you get closer, it's like, hey, remember how you said you needed 2 design partners? Can we have that conversation again? I'd love to give you an update. So that's always a nice way to also build confidence. You're building that rapport and relationship over time. A couple more things. What does your cap table signal? This is a little bit about touches a little bit on Nate's point about the legal piece, right? So your cap table is about incentive alignment of everyone in the business, right? So when you're bringing on investors, they are on your cap table, right? But before that investment, sometimes we'll see messy cap tables, right? Things like the founders don't have enough equity. You've given away a lot of free equity to folks who built pieces of it, and now you will effectively own less than 50% of your business. Kind of a red flag for me, because I'm like, oh, I don't want an employee, I want a founder who's in it for the long haul. Sometimes you had a co-founder, you were equal partners, your co-founder has left, but they had already vested 50%. Oh boy, like that's like equity that is no longer productive for the forward motion of the company. And then debt and founder loans. Basically, any of those loans, they're in line to be repaid before investors. So that needs a little cleanup. So just a few stray things from there, right? We'll close this up with where do I go, and then we'll turn it over for questions. So we've thrown a bunch of things at you again. Point is not for you to remember exactly everything that I talked about. Some of the things are probably not relevant to you today. But hopefully there's 1 or 2 things that you're like, I'm going to go work on this for myself. One thing I think it's really hard as founders. I want to recognize that what you're doing is that you're really kind of stuck in this middle point of, and I would say it's an isolating and sometimes lonely place. Right? You're in the middle of having your team, building things on one side, trying to move your company from risk to value, trying to make progress on proving out your business model, trying to get your sales cycles going and shorter. And then on the other side, right, if you do go for venture capital, you're always also listening for the market for capital. What makes you exceptional at each stage? So you're kind of always in this like zigzag, right? Zigzag point. So it's tough, right? You're kind of stuck in the middle. So just know, this is not like here's how to not be in this zigzag. This is more of a recognition of the balance that you're doing as founders. So where you go from that, knowing that, right, for you to keep track of this left side, you're really trying to do the stuff in blue, right? You're going and doing a bunch of reading, but you're also talking to founders, talking to the community, kind of getting your sort of mind around what are the norms around valuation for my stage, my market, my type of team. How is that different from other places? Like, I happen to have a lot of family in the middle of Ohio. Would I be more attractive if I started raising over there? Maybe, maybe not, right? What's unique and notable about you within your market, right? What makes you stand out? If you said, hey, I'm building a cloud enterprise SaaS business and I was at Microsoft here in Seattle, there's a lot of people doing that, right? And so what might be unique? Who's most active at your stage? I would say, Kirby Ascend's Seattle Startup Toolkit does have a pretty good list of active VCs and individual investors, but that's a list to start from, right? You could take that list from Kirby and then start talking to folks who just raised a round. Oh, which angels are in the round? Because then you'll probably find out that some of those folks are not as active anymore, and so it may not be worth all the cycles of just of trying to get a warm intro to them. And what are the milestones that they're expecting? Have you validated them with the next stage, right? It's always a little bit of a flag for me when I talk to founders and they're like, well, by the next stage I expect to be here. I expect to have my first revenue. And I'm like, oh, that's not really a seed milestone for your market, right? Or for your type of company. And then what's changed in the past 3 to 6 months? I think especially today, it's really important to try to keep up with sort of the changing environment of what's market, because it is changing quickly. So let's move on to questions. So that's just a bunch of stuff. More important is your questions.
I've got one.
Yeah, I bet you do.
I'm so sorry. So, thank you. There's a world of difference between pre-revenue and post-revenue.
Yeah,
As such, if you're pre-revenue and raising,
yeah.
I would think you'd want your main milestone to become post-revenue. Would you agree with that? There's a second part to this. What?
Yes, well, I would say yes-ish.
Okay, yes-ish.
Yes.
Now, with your yes-ish,
Yeah,
I noticed that when you raised, everyone talks about 18 to 24 months between stages. But if you think you can get to post revenue within 6 months, would you suggest raising enough to get to a 6-month stage?
I love this question, and I love how you're thinking about it. Yes, I would consider sort of pre-seed and seed almost like stages, right? So let's say you're pre-revenue, and you're like, but I have line of sight on my first set of customers, and I think I can get there. And if I get there, that changes sort of the valuation or the stage of your company, right? So you're pre-revenue and you're like, okay, I'm going to do a little bit more dilution in that first round. I just need 500K to get there. I'm going to dilute myself a little bit more than prior, than I want, because these investors are taking that risk to say, I believe you can get to revenue, right? And then once you get to that revenue point, yes, go raise the next million or $1.5 million at a slightly, you're on the now higher side of the valuation, right? And then I would look at those two rounds kind of in average, how much have you diluted yourself? But right, like I think you're right to recognize that the folks who are willing to take a bet on you in a pre-revenue state are going to be less. So you have to find the right set of investors there. So thinking about the stages and the tranches of funding, I think that works pretty well.
Excellent, thank you.
Yeah. There's a question.
Thank you for coming.
Yeah.
You mentioned on one of the slides messy cap tables.
Yes.
I've gotten different thoughts on crowdfunding, on
Okay.
source of crowdfunding, and how that influences you as an investor or the cap table. What are your thoughts on that?
It's a good question. I mean, I'm trying to think of like whether, I don't think we have any in our portfolio, but my general view, there's the equity crowdfunding piece and there's the general crowdfunding piece. And I think for, let's say you're a hardware company that you're using part of the crowdfunding as your sort of lead gen for your customers, I think that's a little bit different, right? You're kind of showing buy-in from the customer or from your target market. So that can be, I think as long as you know what it's showing, it's more showing the, it's showing target market demand versus like, it's not your proof point. That's not your end game around go-to-market, right? Like that's not how you're gonna sell. So I think that's the one thing that can be tricky. I can see for some folks that it feels like a distraction because there's a lot more, I would say, constant marketing that you have to do, right? You're like, oh guys, I made this cool video, this thing is coming like online, you just gotta prepay, and I'll go build the thing, and then you have to give them updates along the way, and then like, they got their thing, now what, right? You wanna keep them, so you gotta keep, turning on the marketing machine. So I think I could see it as, that's where I would see it as a potential distraction. But for me, it's just more understanding how it fits into your overall go-to-market strategy and how it serves as a proof point. It could be good as like, hey, nobody has built this, rocket chair before. I'm like, who wants a rocket chair? I have no idea. But look, all these people signed up to buy it, and they gave me money for it. It might be, I don't know, I'm not sure. I'm not a consumer hardware person, so I'm like the wrong person to use that example, but it could be a demand validation piece. Yeah.
Yeah, thank you for your time in the presentation today. And as a first-time founder, underrepresented founder, a lot of the ladies in the room, there's a bit of a power differential in approaching investors for the first time, and sometimes we don't have that network. We don't have the ability to do some of the friends and family to get us in. So in terms of building our network of investors, whether it's cold reach out or networking events, how do we begin to build a network of people like you?
Yeah. Well,
Today's a good start. But.
Today's a good start. Showing up, asking questions, awesome. But and it is hard, right? Because Minda and I, part of First Row is being approachable and being at these places in accessible ways. So, and we are not the full capital picture of Seattle, right? And so I think that's a tough question. I do think, let's see. In terms of meeting people, I do think networking events, Seattle, especially the startup ecosystem is fairly small and tight-knit. And so going to a few events, I'm actually not super extrovert, so I love having a very prescriptive way that I go to events. And this is from Elizabeth Scallon, who, if any of you folks know, she is fantastic, and everyone knows her in the community. But what she does is she's like, here are 5 people I need to meet, whether it's personas or specific people, if you have a list beforehand. And just make that goal and then go and meet those people, and then you can go home. And when you do meet them, I would say, like, use it as an opportunity to practice your very, very short pitches. What are the things that I'm going to say to you that make me memorable? Right, the goal is memorable and get me to the next meeting, and so it's a good opportunity to just practice those, your elevator pitch, if you will, and more importantly, thinking about using it as an opportunity to elicit more from that person than you are talking. So in that first interaction, if you're talking for like 90% of the time, they might forget you, right? But if you're actually about 50-50. You're probably going to remember that conversation. And so I think it feels almost counterintuitive, because I'm sort of saying, like, rather than having a really broad network, really try to go a little bit deeper on each. I think that'll help, because you never know the next conversation that you have that will lead to something fruitful for you. For First Row, we never take a transactional approach with our relationships. Founders that have passed on will send me deals. And I think that speaks to a lot of the human nature of it. So I would think about, like, what are the 4 or 5 people in the community that really need to know me super well. The other piece I'll say, and I think especially as folks who are in any underrepresented category, it can feel really uncomfortable being in the room, because there's like these, I don't know, I call them like the rude questions that you assume, right? The reasons why people are like, what are you doing here? Right? Like, they're never going to ask you that, right? But that's sort of the question that I have underlying sometimes. And so I often just write those out. I write them for myself in like the rudest way. And this is true of your fundraising narrative as well. The thing you're most afraid of people asking, write it down. Because then you can actually be more proactive and be kind of on the offensive about making sure you address it straight up. And that builds more confidence, and that also makes you more, I would say, like of an attractive conversation partner. So I don't know, that kind of weaved around, it went into some different areas, but those are a couple of things that popped to my mind.
Thank you.
Yeah.
Excuse me. Thank you for coming today. It was a great talk and really good information on sort of what to say and what to put in the deck and how to approach and engage with investors. But if I look at your website, it says that you take an arts-based approach to evaluating opportunities and teams and so forth. So I was wondering if you could comment, maybe not specifically on that, but maybe some of the soft skills or the other sort of attributes that someone might want to have as they approach and engage VCs, in addition to all of the information that you shared with us today.
Yeah, that's a good question. I think in terms of the soft skills, I definitely feel like one thing that would delight my partner, for example, to no end, she is a stickler on like the proactiveness, like calendar diplomacy, she calls it. And it's if you can reduce the amount of times you and I have to go back and forth about when the heck we're meeting and where we're going to meet and all that, that saves her a bunch of time, and that gives you a little bit more, like, I don't know, patience runway with her, I suppose. And so it feels like a small thing, right? But that's not just in saying, hey, let's meet, here's my Calendly. That misunderstands a little bit about the power dynamic that is at play when you're asking somebody for time. But instead just being like, hey, does this time work for you? or does this time or this time work for you? She says, oh, this time, make it like, you made it easy for me to say yes. And then she just said, oh, also, here's a calendar invite, and I've already set everything up, right? Again, you're making it easy for me to just show up and have everything I need. And so that can go a long ways. And I think that's actually true of a lot of cold outreach as well. Just thinking about like knowing that we are scanning through our email at like less than 10 seconds per email. Like, how can you make it really easy for me to go, oh, this is interesting. Oh, this is a team that that makes me lean in. And yes, I will meet with you, and here's how it's really easy for me to say yes. And so just the quicker paths to saying yes and trying to find those shortcuts is really what I would think about as a soft skill development.
Hi. I'm curious, in your experience with funders, is it very common for like talking to someone, they say no, but they'll say like, you should talk to this person? Like you say, Seattle's pretty tightly knit.
Yeah, it depends. You know, I would say there's some folks, again, it's like there's some folks who say no, and any intro from them, it's kind of tricky, right? Because it's like, oh, well, I passed on them, but you can take a look. Like, that's like, that feels kind of icky. In our case, we often do help connect folks, partly because we are clear about the types of risks we like to take. And so, you know, my husband also happens to be a VC, so often I'm like, hey, we actually don't take this type of risk, but you guys do because you know the space better. So I might toss it his way. Or I might say, oh, this is a, you know, commerce-y deal, and I don't know, or a consumer-y deal, and I don't do as much consumer at the earliest stages because I want more signal. But I know these folks who take that risk because they're from that background. So we do a lot of that, but it's not true for everyone. And I think for some folks, you kind of have to figure out when somebody says no, and are they saying no from a specific, I don't take that risk perspective, then it's worth asking for who else should I talk to. But if it's a no from like, I just don't get it, then any intro they give you is going to be, you know, kind of lukewarm at best.
Thank you. Great overview. So the having a lot of investors can be like herding cats. So I was curious, what is your perspective on what is the ideal number, or not to have more than X number? What do you recommend?
I think it's true. Not having a lot of investors is going to be helpful as you go forward. Often, you know, as an angel, some of the earliest rounds I was part of, at some point later on, and this is ideal, right? As an angel, like 3 years in, I'm not getting anything. The deal has moved on. They're doing Series B, and that Series B investor has now decided to just like consolidate and buy out all the angel investors. That's great, and that also simplifies the cap table, right? Because every time as a founder, you're doing something of note, you need to like inform people, and if there's signatures needed, gosh, somebody who wrote a $10K check for you 7 years ago, they're vacationing in the Bahamas, who knows? And you have to go like, hey, can you sign on? Like, that's annoying for you, right? And so I think that's sort of the balance of when you're bringing out those earliest checks, you're like, cool, like I got my friend's friend to write a $1,000 check, great, but just know that like at some point it will compound. And so some of the things that I've seen help, you know, when angel groups will sometimes do this, they'll syndicate the deal or at least pull together some sort of an entity so that these small checks can go into it. AngelList has like a roll-up vehicle. Some of those things help consolidate all those little checks under one entity, so you're only chasing one person versus, let's say, 50. So I think those things can help simplify it. But in general, you know, I would sort of set a pretty, you know, a standard minimum. In Seattle, I've seen most of the minimums be about $25K for individuals, and try to stick to that. And that'll, you know, that kind of helps you keep it in a manageable place. Yeah.
Okay, I think it's my turn, unfortunately. Can you all please take a moment and thank me? Don't thank me. Join me in thanking. do that all the time. One of these days I'll get it right. There were a handful of questions that were still out there, so I don't know what the demands on your time are, but you know, I would block the door if you have questions, or get a number or business card or something, because very great topic and just really wonderful advice. And thank you again for coming to share your experience and your thoughts with us today. Next Friday at noon, we're going to do it all over again. We're going to have David Schultz, who's co-founder and the COO of Monode Bio. He's also a translation advisor for the Institute for Protein Design here at the University of Washington. His talk will be titled From Takeoff to Cruising Altitude. Might not be the best metaphor these days. Finding the right trajectory for your startup. But David's a great guy. Monode's been very successful, and I'm sure he'll have some really good lessons for us all. So sign up today, and we will see you next week. Thank you, everybody.